Imagine a scenario where the money in your wallet loses most of its value almost overnight. In 1923 Germany, hyperinflation was so extreme that landlords were paid rent with bundles of worthless banknotes. And one industrialist, Hugo Stinnes, became the richest man in the country by borrowing huge sums and buying hard assets before the currency collapsed. His debt shrank to nothing in real terms, while his factories, mines, and real estate skyrocketed in price along with everything else. It's a counterintuitive story. In a currency meltdown, real estate can simultaneously create fortunes for some and chaos for others. This raises a big question. What would happen to American homes if the US dollar were to collapse in value? History offers some clues about what would happen in a real currency collapse. In Germany's hyperinflation era, the value of the mark fell so fast that by late 1923, virtually all debts, including mortgages, were wiped out in real terms. Borrowers could pay off houses with a handful of notes, while lenders and savers were absolutely ruined. Renters under long-term rent control effectively lived nearly rent-free as their fixed monthly payments became absurdly small in value. Meanwhile, property owners saw nominal prices for land and buildings explode into the billions. But those billions of marks had almost no purchasing power, no real value. A house that sold for a fortune in paper money might only trade for the equivalent of a few ounces of gold or a few loaves of bread in real value. More recently, countries like Zimbabwe and Argentina have faced episodes of extreme inflation. In Zimbabwe's 2008 hyperinflation, where prices were doubling daily at one point, people desperately converted cash into tangible assets. Land, cattle, houses, as quickly as humanly possible. Real estate became a refuge to store value when the dollar, the Zimbabwean dollar, became essentially worthless confetti. In Argentina, where inflation is persistently high, it's common to see homes priced in US dollars or even in inflation-indexed units rather than the unstable local currency. These examples show a pattern. When a currency collapses, real assets like houses tend to hold their worth better than paper money. The US has never experienced a true hyperinflation. What happened in 2022 and 2023 wasn't even close. But it has seen high inflation in the 1970s and deflation in the 1930s, both of which had dramatic housing market impacts. An outright dollar collapse would be unprecedented for America. Yet studying these extremes elsewhere helps us understand the mechanics. For the US dollar to collapse, we'd likely be looking at a perfect storm of events. Imagine confidence in the dollar evaporates due to massive money printing, soaring debt, or geopolitical shocks. This is not a far-fetched thought experiment. The US government's debt now exceeds $34 or $36 or $37 trillion. Who knows what it is at this point in time because it just keeps going up. And interest payments on that debt have surpassed military spending. History suggests that when debt loads become unsustainable, governments face a dilemma: print money and inflate away the debt, or default. The US would almost certainly choose the inflation path to avoid outright default. A hypothetical collapse scenario, that inflation could spiral out of control, triggering a chain reaction in the economy. First, inflation would surge, meaning prices for everyday goods skyrocket as the dollar's purchasing power plummets. Rates would then spike dramatically in an attempt to curb inflation, or because lenders demand huge returns to offset the dollar's weakness. We've seen a mild version of this in recent years. When inflation picked up, the Fed raised rates, and mortgage costs went through the roof. And this cooled the housing market. But in a collapse scenario, this effect would be far more severe. Mortgage rates in the double digits would make borrowing for a home incredibly expensive. Home sales would likely plummet, with financing being scarce. Buyers simply couldn't afford current prices. Credit would dry up. Banks and lenders, fearing borrowers won't be able to repay in stable value, would tighten lending standards or stop long-term loans completely. Those that do lend would charge outrageous fees. New mortgages could become nearly unattainable, especially for first-time homebuyers. The housing market might freeze up with very few transactions as sellers refuse to accept dollars that are becoming less and less valuable. At the same time, history tells us that while new construction might not halt completely, it would fall sharply. The cost of building materials and labor would shoot through the roof as the currency falls. If a gallon of gas or a sheet of plywood costs 10 times more this year than last year, builders can't commit to fixed-price projects, and developers pull back. Fewer new houses being built means an already tight housing supply gets even tighter. Ironically, that scarcity could put upward pressure on home prices in the long run, even as the economy falters. Existing homes become hard to replace, giving them kind of a scarcity value, and houses turn into the new gold for those looking to park wealth in something tangible. As one analysis notes, real estate, being a hard asset, tends to appreciate with inflation, serving as an inflation hedge. Indeed, over the last 60 years in the US, home prices rose about 2,350%, while consumer prices rose 896%. Homes rose significantly more in value than most other goods. In a hyperinflation environment, that dynamic could be even more extreme. Nominal home prices might skyrocket simply because the dollar is worth less every day. So initially, we'd see a paradox. Affordability craters because loans are unavailable and income lags prices, even as the sticker price of houses shoots up, reflecting the dollar's drop. In real terms, home values might actually fall if the broader economy is in shambles. But expressed in dollars, a modern suburban house could be worth millions or billions of dollars on paper. The housing market's true value signal gets distorted by broken currency. Not everyone in the real estate equation is affected equally. A dollar collapse would create clear winners and losers in the housing sector, often in surprising ways. Existing homeowners with fixed mortgage rates, these might be the biggest winners. If you have a 30-year fixed mortgage at a low interest rate, high inflation will effectively inflate away your debt. But one thing to note here, that may not necessarily be true, and I'll link to a video that explains what happens to your debt when the dollar collapses, or more precisely, what could hypothetically happen to your debt, because there's more to it than just this. But in theory, every future mortgage payment would be made with dollars that are worth significantly less, making the real burden of your loan shrink dramatically. Historical hyperinflations literally erased mortgage debts. German banks in 1924 found that mortgages had been repaid with nearly worthless currency. In a US collapse, a homeowner with a fixed loan could potentially pay off their house with a few weeks of salary, since that salary might be in wildly inflated dollars. They keep the house, a real asset, while the lender gets back nearly nothing of real value. In other words, debtors win, creditors lose. Those who have variable interest rates or need to refinance could be in trouble. As the Fed hikes rates to fight inflation, adjustable mortgage payments would spike painfully. Many could find that they can't afford the new payments and might default. New buyers, even if they somehow qualify, would face interest rates so high that a mortgage payment on a modest home could rival a current-day luxury home payment. These homeowners are in a precarious spot. Without the protection of a fixed low rate, they would face the crushing side effect of inflation. Now, let's talk about renters, because renters don't generally have hard assets to protect them, and as a result, they could end up as the biggest losers in a dollar collapse. If landlords' costs increase, they will try to raise rents aggressively to keep up. We could see rents reset monthly or even weekly in extreme cases. Unless wages keep up with inflation, which they often don't, at least not at first, renters' costs of living would soar. Many would struggle to afford basics like housing. On the other hand, if the government imposed rent controls or freezes to protect tenants, that could backfire by causing landlords to defer maintenance or even abandon properties, since rent collected would become absolutely worthless. Either scenario is bad for renters' quality of life. They either pay through the nose or find fewer livable rentals available. In a chaotic collapse, we might also see more people doubling up in households, moving in with family, or even a rise in homelessness as rent becomes unaffordable. Wage earners and those living on cash savings would be hit hardest, while hard asset owners would fare much better. As far as landlords and real estate investors, this group's fate would vary. Owners of rental properties with long-term fixed financing would, like other debtors, see their loan burdens melt away. They could actually come out ahead in asset value, and rents would eventually rise substantially in nominal terms, potentially boosting their income once leases reset to new price levels. However, the transition period could be very rocky. Landlords might face tenants unable to pay, higher vacancy rates, and government pressure not to evict people during the crisis. If landlords raise rents to offset inflation, they risk higher vacancies as tenants leave or downsize. There's also a danger that widespread foreclosures from those adjustable rate homeowners mentioned earlier could flood the market with cheap houses, giving renters an opportunity to buy distressed homes and undercutting rental demand. So a savvy landlord would need to manage carefully. In the long run, they hold a hard asset that should retain real value. But in the short run, cash flow and property management could be very challenging. Though not real estate per se, it's worth noting that banks holding fixed-rate mortgage assets would be big losers in a dollar collapse. They'd get paid back in near worthless currency, while any deposits or savings they owe to customers lose value too. In past hyperinflations, banks either failed or had to be bailed out or restructured afterwards. In the US, a collapsing dollar would almost certainly entail a banking crisis, which could compound the housing crisis and extend globally. This is why some experts call a currency collapse scenario counterintuitive. It upends the usual logic of who owes what to who. In summary, homeowners with fixed debts and tangible assets could find themselves shielded or even benefiting, whereas renters, savers, and anyone without real assets would suffer the most. The outcome would not be uniform or entirely predictable. As one investment analyst put it, the effects would likely be counterintuitive to our normal expectations. But there's a hidden mechanism here. Why do some homeowners come out ahead when a currency tanks? The hidden mechanism at work is something economists sometimes call inflation-induced debt destruction. Essentially, high inflation silently transfers wealth from lenders to borrowers. If you borrow $300,000 today to buy a house and the dollar's value falls 90% by next year, it's like your mortgage principal effectively fell to $30,000 in today's money. You still owe $300,000 on paper, but $300,000 is now a much smaller slice of the economy than it was before. Every dollar you pay back in the future is worth less than the dollar you borrowed. You're literally paying the bank back in cheaper money. During Germany's hyperinflation, this process happened so fast that mortgages and other loans were virtually erased. Families could eliminate decades of debt with 1 or 2 monthly paychecks. But that's not to say that that would be what would happen in the US. This is the twist. In a dollar collapse, debt turns to dust, and owing money can become a good position to be in, so long as you owed it in the old, stronger dollars. Meanwhile, having savings is awful. Cash is melting like an ice cube. Savers lose, debtors win. A homeowner with a fixed mortgage essentially gets a windfall. The bank and anyone holding bonds or cash eats the loss. This is why it's so counterintuitive. The people that are supposed to win, the savers, end up being the losers, which isn't what is supposed to happen. It feels completely upside down because in normal times, we consider debt risky and savings prudent. A collapse flips that script. However, it's not that simple for everyone. To actually benefit, you need to maintain ownership of the asset. If you lost your job in the chaos and couldn't make even the small nominal payments, you could still face foreclosure before hyperinflation fully bails you out. Or if your mortgage, by the way, a lot of them probably have this now after 2008, has a clause that lets the bank adjust or call it due to a currency crisis, you might not get off the hook. And importantly, if your loan isn't a fixed rate, all bets are off. In a crisis, the interest rate on an adjustable loan could be jacked up so high that it bankrupts you before inflation saves you. So the mechanism of inflation destroying the debt is powerful, but whether it helps or hurts you individually depends on how you're positioned going into it. And I can't emphasize this enough because there are other things that the government could do in order to make it so you still owe the effective value of your debt to your creditors simply by changing the laws. In the face of a dollar collapse, the government wouldn't just sit on the sidelines. US policymakers would likely deploy every tool they have to stabilize the situation, albeit they'd be doing it incredibly reactively. Initially, the Federal Reserve would hike interest rates fiercely, and that's part of the chain reaction that would slam housing. Beyond that, we could expect emergency measures. For example, the government might offer grants or subsidies to support the housing sector, such as incentives for builders to create affordable housing despite high costs. There could be tax breaks for homeowners to ease the burden of property taxes or inflation-indexed bonds to compensate investors. In extreme cases, the government might even consider some form of price controls, perhaps capping mortgage rates or freezing rents, temporarily to prevent mass homelessness and civil unrest. During World War II, the US did implement nationwide rent controls to contain inflation, for instance. However, such interventions can have side effects. If rents are capped while everything else rises, landlords may abandon properties, leading to housing blight. If mortgage rates are capped, banks might simply stop lending, which doesn't help anyone looking to buy a home. Reducing spending and stabilizing the currency would be the ultimate solution, but those are painful medicine. Historically, currency collapses end when a new stable currency is introduced or the old one is reformed. The US might have to create a new dollar or peg the dollar to some asset like gold temporarily. In Germany, they introduced the Rentenmark in 1923, backed by land and industrial assets to halt hyperinflation, essentially a new currency tied to real estate and goods, not faith alone. It worked to stop the price spiral. In a hypothetical future US collapse, one could imagine a plan where the government says each new dollar is worth 100 old dollars and is backed by a basket of assets, or tied to a global currency agreement. Under such a reset, real estate would be crucial in anchoring value. Land and property are often used as backing for new currencies when trust in paper money fails. One unavoidable long-term outcome would be a massive wealth redistribution. A dollar collapse inherently punishes certain groups and benefits others. We'd likely see political pressure for remedies, perhaps debt forgiveness or adjustments for those who missed the inflation lottery, and new taxes on those who made windfall gains. For example, if a few institutions or individuals used a collapsing dollar to buy up thousands of homes, as foreign investors or cash-rich companies might, there could be public outrage and demands for intervention. Foreign investments is another angle. If the dollar collapses relative to, say, the euro or the yuan, holders of those currencies could swoop in and buy US real estate at what are effectively fire sale prices in their own currency. American homes, from their perspective, would look absurdly cheap. This happened in some smaller countries when their currencies crashed. Properties got snapped up by foreign buyers with stronger currency. The result can be locals being priced out even though on paper their home values are high. It's a paradox of currency collapse. Your house might be worth a fortune nominally, but you could lose it because someone else with more stable money can pay a price you can't match. It's also insightful to contrast an inflationary collapse with a deflationary scenario. The Great Depression of the 1930s was characterized by deflation. The dollar gained value as prices fell, but jobs and incomes fell faster. Many homeowners then lost their houses because their incomes dropped and debt became relatively more expensive, since dollars were more valuable, leading to foreclosures. A dollar collapse is the opposite. Incomes might rise in nominal terms. You might make $1 million a year, but that buys what $50,000 used to, and debt becomes cheap. But the challenge is that incomes typically lag behind price increases. It's a race that households could lose in the short run. In both scenarios, people lose homes. In the 1930s because they couldn't earn enough, and in hyperinflation because they can't catch up to rapidly rising costs. The lesson is that stability is key. Moderate, predictable inflation or deflation is manageable for housing, but rapid swings in either direction wreak havoc. Other countries that have faced high inflation have adopted coping mechanisms. For instance, some have inflation-indexed mortgage rates or rents, where payments adjust with an index so that real values stay constant. This protects lenders and landlords, but can squeeze borrowers and tenants who then shoulder all the inflation risk. If the US saw a coming inflation storm, we might see more of such financial products to spread the pain over time instead of a sudden collapse. But the real question is a dollar collapse likely, and what can we do about it? The very idea of the US dollar collapsing might sound like fantasy or doomsday chatter. Indeed, most economists consider a sudden collapse highly unlikely. The dollar is deeply entrenched as the world's reserve currency and the backbone of global trade. For it to fail, there would have to be a profound loss of faith by both international and domestic players. That said, concerns about US debt and money printing are real. What's more likely than a dramatic collapse is a slow erosion of the dollar's value, a steady high inflation, or a gradual shift where other currencies' share of global reserves inches up, diluting the dollar's dominance. This kind of slow burn inflation, sometimes called financial repression, when governments deliberately let inflation outpace interest rates, is already a subtle factor benefiting real estate. For example, in the past few years, US inflation ran above 5% while many homeowners had sub 3% mortgage rates, effectively giving those homeowners a free gain in equity as their real debt burden shrank. In that sense, a mild version of the dollar collapse mechanism has been at work, just in slow motion. Whether or not we ever face a true dollar collapse, thinking about this extreme scenario sheds light on how our financial system values real estate. Ultimately, a house derives its value from being shelter in the real world. If the measuring stick, the dollar, breaks, the house is still there. Its value will be recalibrated in whatever new terms emerge. Real estate tends to survive currency failures. It's the people and the institutions around it that may not. An old saying goes, buy land, they're not making it anymore. In a currency crisis, that logic appeals to people. Land and buildings feel solid when money feels like monopoly paper. Indeed, financial advisors often suggest holding some real estate assets as a hedge, be it real estate, gold, etc. Yet, being a homeowner during such a crisis would be anything but easy. You need to weather spiking taxes, since property taxes might be reassessed on those skyrocketing nominal values. Higher insurance costs, replacement value of the home shoots up, so do insurance rates. And the general turmoil of an economy in disarray. You might have a paid-off house, but still struggle to afford utilities or groceries. So while owning a home is arguably better than not in a dollar collapse scenario, you have a tangible asset, you have a place to live, and your wealth isn't entirely in cash. It's not a ticket to Easy Street. It's more like a lifeboat in a storm. Better than being in the water, but you're still in the storm. A US dollar collapse would fundamentally rewrite the rules of the housing market. We'd see a period of turmoil where prices go wild. financing disappears, and ownership patterns shift in unpredictable ways. The humble 30-year fixed mortgage could turn into a powerful wealth shield for some, while millions of others struggle to keep a roof over their heads. Real estate being real would outlast the chaos of a currency implosion, but who owns it and on what terms could change dramatically through the crisis. The thought experiment of a dollar collapse ultimately reminds us why stable money matters for a healthy housing market. It highlights how intertwined housing is with broader economic confidence. If nothing changes and somehow the unthinkable happens, American homeowners and renters would find themselves navigating a world where the only thing more valuable than a house might be the certainty that it provides shelter. As we enjoy relatively stable times today, it's worth asking, how do we ensure our financial foundations remain sound so that homes remain homes and not just chips in an inflationary casino? In the end, perhaps the best takeaway is to be prepared and thoughtful, holding a diversified set of assets, including real estate if possible, and not over-relying on the assumption that currency will always hold its value. The dollar collapsing is a remote scenario, but talking about it and examining it reveals the hidden gears of our economy, showing how cause and effect in finance can turn our lives upside down. Real estate in the US would survive a dollar collapse, but it would be a very different world. One where understanding those hidden mechanisms could make the difference between losing everything and coming out ahead. And that knowledge, how the system works, is in and of itself a form of currency that you never lose. And by the way, this whole thing, as soon as we get into the debt conversation, becomes really complicated. So if you want to see what would happen to your debt if the dollar collapsed, make sure you check out this video right here.